Good Monday morning. Welcome to Connect, the California MBA's weekly podcast featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Dustin Hobbs, Communications Director here at the California MBA. We've got a great guest today. I'm excited to dive into the conversation with him and find out what his thoughts are in the industry right now. He's one of the powerhouses on the legal side of the industry, so I'm really curious to see what his thoughts are on some of the big cases going on right now, some of the legal trends in the industry. And we'll get into that here in just a moment. But first, let's thank our sponsors over at Incelerate. Incelerate, the leading mortgage lead management CRM and engagement platform that helps lenders close more loans by increasing efficiency gains across sales, marketing, operations, and management, has recently announced the first of its kind mobile app. The groundbreaking mobile app delivers full lead management, lead distribution, click-to-call, inbound call routing, first call automation, and two-way compliant text messaging, and provides access to critical loan information without having to use a laptop or log into your LOS system. It also empowers loan officers by intelligently distributing leads, managing pipelines, prioritizing your day, automating best practices, and personalizing the borrower's journey, all from the mobile app. So for more information or to catch a demo, visit incelerate.com, or you can call the number listed here in the description below. Okay, let's jump into the conversation. I'm excited to welcome in Michael Pfeifer. Michael Pfeifer is an attorney with Kirby McGuinn. He's also the general counsel at the California MBA and has been for a long time. And he's also a longtime supporter of the industry and of the California MBA in particular. And Michael has been instrumental in guiding our legal issues committee for years, and even kind of starting in getting our legal issues and regulatory compliance conference off the ground years ago. And so I'm really excited to talk to Michael and find out his background and what his thoughts are on the industry today.
Good morning, Dustin. It's great to be here. Thank you for this opportunity.
Yeah, of course. It's a long time coming, I think. So let's dive right in. Why don't you start with your background, Michael? For those that don't know you well, I know that there's a lot of folks, particularly on the in the legal side of the business, that have known you for a long time. But for those that maybe don't know you well, let's find out more about your background. What led you to the mortgage side of the legal industry?
Kind of a long story. A lot of people that I have met in the industry did not have this as their first career choice. They ended up here after going to a number of other things. And I kind of personally feel like, I mean, even though I didn't know this in advance, I think I was sort of destined to be here. I knew I wanted to be an attorney when I was 12 years old, and everything that I did after that, in terms of my schooling and everything else, took me to that goal.
I'm curious, what inspired you to be an attorney at 12?
I was interested in politics. I thought at some point in time I would go into politics, and people said, well, you have to be an attorney to go into politics. And so it's like, okay, well, I'll do that. But I was always interested in real estate. And when I was at college, I grew up in a working class family, and my parents were. My father was a plumber, and then he was involved in the plumbers union, and he got me jobs in the summertime working in construction. So I did a lot of real construction on apartment buildings and houses, and I expanded my verbal vocabulary through that experience, and knew then that I wanted to be a lawyer and maybe learn some other words. But it was great. And then when I was in college, I had the opportunity to, I'm still following a political career, but had the opportunity to go to London for a year at the London School of Economics, and just became much more interested in the financial side of things. And when I came back to America and went to law school, I ended up at Cornell University up in upstate New York, and one of the professors there thought I had an aptitude in real estate. I really wasn't. I wasn't sure what I wanted to do. I thought I would go into antitrust and
the international lingo that convinced him that your future was in real estate.
Yeah, I guess. And it was, I thought it would be, international law or something, but because I had spent the time in Europe. But he made me a research assistant for the book that he was working on. And back then, I mean, this was, I'm old. This was a while ago. This was in the early 1970s, like 1973 era. And The work that we did was, some of the new things that were going on right then were planned unit developments. I mean, nobody, that was a revolutionary concept to have homeowners associations and things like that. And that was a brand new concept. And so we did a lot of research in that, and he wrote a lot of articles on that. And he later became the dean of the law school. But I just loved doing that work. And but I still went ahead and got a degree. My degree from Cornell is with specialization in international legal affairs. But once you get out of law school, then the real world hits. And I got a job in Los Angeles. I was recruited out of the law school for a job in Los Angeles, and I had wanted antitrust. So I went to work for a big firm in Mid Wilshire, and we represented a lot of big oil companies, Exxon and Mobil, and a bunch of companies on antitrust cases. And but I found that totally boring, and ended up saying, I had a family. I had a daughter that was born in the last year of law school, and I didn't want to live in Los Angeles. And so we moved to Orange County. I managed to snag a job with a law firm there that was representing a lot of developers. And again, this was 1975. Orange County was just beginning to grow. We represented all these developers who were building these high-rise buildings, and it was really kind of a gold rush time because the opportunity was there, the money was there, and so we represented them all in litigation and issues. I also represented a couple title companies, so I got familiar with that. So my real estate career just seemed like I was headed for that direction. As time went on, I was with that firm until about 1985, and then went with a large firm that out of Beverly Hills that did nothing but represent banks. So did a lot of commercial bank loan workouts. So was right in the thick of it in I guess the original savings and loan crisis.
I should say the S&L crisis had to be right around then, yeah.
We represented a lot of savings and loans, and we also represented what was then called the FSLIC, Federal Savings and Loan Insurance Corporation. And when they started, they ultimately, and the FDIC got involved as well when things started to fall apart. So we represented the FDIC, we represented FSLIC. We ended up representing an outfit called the Resolution Trust Corporation, which helped resolve some of these things and was one of the pioneers of the securitization concept, that you could take a bunch of these bad loans, throw them together, and put them into a pool of loans and sell them to investors. And so we were very much involved in that. I spent a lot of time at the FDIC's offices in Irvine, and they would take over the banks, and we would then work out their loans. So I did that for about I don't know, eight years or something, and then in 1994 went into partnership with a fellow in Newport Beach that had a bankruptcy and foreclosure firm and that specialized in representing mortgage banks. And my job was to handle the complex litigation that spun out from those cases. So did a lot of mortgage fraud work and recovery of fraud loans and real estate finance disputes and that sort of thing. But got very interested in loan repurchases, and wrote an article in 1995 on loan repurchases and some of the defenses that could be raised. And at that point in time, people really weren't thinking about loan repurchases, and that wasn't a big deal. But I spent a lot of time doing researching those and writing that article, and that opened the doors to a lot of things. I eventually split with that partner in 1997, opened my own law firm, and said, if I'm going to do repurchase work, I might as well go talk to some of the big lenders. So I basically just figured out who to talk to at Countrywide, went up to their offices in Calabasas and said, hey, I know about this stuff. I'd like to do some fraud recovery work, maybe some repurchase work. And they talked to me and said, well, you're cheap enough, you're small, we can take advantage of you. So it was one of those mutual sort of things. I said, well, that'd be great. Take advantage of me. Just give me some cases and go. And so I did that, expanded my firm. Eventually, I think I had, 8 or 9 attorneys there. And we did a lot of repurchase work for Countrywide and for a number of other mortgage companies, and managed to get a position. And again, one of these things where went to one of the quality assurance conferences for the MBA. I think this was in 1999, and had a meeting of the committee there, quality assurance committee, and there was 4 people in the room. I said, well, the committee's kind of falling apart. Who wants to be the chairman? And everybody looked around. Nobody wanted to be the chairman of the committee. I said, well, this is like an opportunity to me. I remember it very clearly. I was up in San Francisco, and I said, I'll do it. I'll be the chair of the committee. So we formed this little committee called the Fraud and Ethics Subcommittee, and what we did was we would meet. I started off just using my own phone and paying for it, but we would have these conference calls once a month. We had some great people on there. We had Jim Croft from Mary, and we had some people from the not the FDIC, from Fannie Mae, Freddie Mac, and some other people. And people were interested in that. They were interested in stopping fraud, and so we would talk about ways to do that. And we said, one of the main things we'd love to do is have a universal mortgage loan officer identifier. Yeah. That's something we thought was really critical and essential. And we didn't know about the NMLS wasn't in existence at that point in time. None of that was there. But these are things that grew out of that committee. A number of the people who were involved in that went on. One of the guys, Bill Jacobson, he was with Mary. He went on to be head of the CSBS, and some of the ideas that we had in that committee ultimately became the framework for the NMLS. So it was a worthwhile activity. And I was the chair of that committee until about 2003, and during that time I met Susan Milazzo, and she was taking over, I think, as executive director of CMBA at that point in time. And I went to her and I said, I'd like to, the Mortgage Quality Assurance Committee for CMBA hasn't really functioned for a year or two. It was kind of quiet. And I said, again, it's one of those opportunities where, nobody else wanted to do it. And so I just said, well,
picture a world where that's not a priority.
Yeah, it wasn't a big thing. I mean, it was, this was at a time when, it was fortuitous. And so we had just finished the mortgage fraud committee for the MBA. We had just finished publishing a book. We edited a book that we put together. Everybody wrote for it, but it was called Combating Fraud and Unethical Practices in Real Estate. So we published that through the MBA. When that was over with, well, I've done enough here for the MBA. And so that's when I approached Susan and I asked her about it. And she said, yeah, sure. If you want to do this, great. So, and so I took that on, and we modeled it after the Fraud and Ethics Committee of the MBA. And we would have, monthly calls and that sort of thing. Some of the same people were involved in it. And it was started off just, 3 or 4 people, but it expanded and grew. And I presented it to the board of directors of CMBA, and they liked it. They thought it was a great idea. And so much so that they said, well, we'd like you to be a director, and we'd like you to expand it and make it go someplace. I said, okay, well, I'll take that chance. I mean, that's a great opportunity for me. So chaired that committee for a number of years, and we grew it and expanded it, and I think it's turned into a great success.
Oh, yeah.
Over the years. So it was one of those things where I just, meanwhile, I was continuing with my firm and continuing to do repurchase work and all other kinds of things. But as the regulatory environment continued to become more complex and people began to look at regulations, sort of began to look at that a little bit more carefully as well. And through my work with MQAC, began to try to understand a little bit more about those regulations, and started ending up, people would call me and say, well, can you help us with an enforcement action that we have? We've got the at that point in time, it was just the Department of Corporations are asking us about our license, but as that developed, obviously we had the crisis of 2008 and all of the repurchase issues and everything else. I felt like I was like Forrest Gump, like I was I guess was in the right place at the right time for a lot of these things. So we, continue to represent a lot of people and on these kinds of issues. And the more you spend time doing things, obviously, the more you learn about it, and the more you begin to understand it, and the more effective you become, and the more effective you become and successful, then it's like, well, I like this. I'm having fun, it's successful. So that's a long story, but it's kind of a winding path. But at a point in time, I was on the board of directors for 3 terms for California MBA, and a term off after that. And I said to Susan, I said, well, you don't have a general counsel. I'll do that. You interested in that? And she made it very clear. She said, I said, how, you don't expect to be paid anything, do you? I said, well, I said, maybe from time to time, but no, I don't expect anything. I'll just do it.
Devotion to the industry, Michael.
That's right. And she is very clear. I mean, she's terrific. And so I said, no, I'm just grateful for the opportunity to do that. So I did that. And that was, I don't know, about 9 years ago, 8 or 9 years ago, and have continued on since then. So I closed my own office at the end of 2017, and I just, didn't want to do all the work to maintain it, and just became of counsel with Kirby and McGuinn on January 1st, 2018, and have continued to work in that environment. It's been a lot of fun, and I've really enjoyed all my years working with CMBA and with you. And I remember when you first started, I joked about you on your birthday that I think I knew you since you were 12. You were just, you were just a young man. I think you were. It felt like you were just barely shaving at that point in time.
Seriously, it feels like it now too. Yeah.
And now, now you're a father, and you're a prominent person in CMBA, and it's funny how if you just stick with something long enough, then eventually it begins to bear fruit. So that's kind of been the story of my life.
Yeah, well, that's really interesting. Well, and I feel the same way about the industry too. I mean, it's one of those things where it's always dynamic, always changing, and so it's always been interesting to me. It's you mentioned that some other aspects of the law were not quite as interesting. I think real estate and mortgage lending, it's always interesting. There's always something changing. The end goal is still the same, but how we get there seems to always change from year to year.
I didn't mean to interrupt you, but I wanted to say something in that regard. One of the things that attracted me to it as a litigator was this is all very complex stuff, and there's a million ways in which you can go wrong. I thought, what a perfect environment for a lawyer. What a perfect environment for a litigator. There's not going to be a lot of work there. So
it's 100% job security.
100% job security.
That's hilarious. So to that point then, so what would you say, looking back at this point, what was your biggest challenge or maybe your greatest victory as an attorney in the industry?
Boy, I think the biggest challenge is basically getting on top of the law in this area. It has grown so quickly and changed so radically over the last few decades. When I first started, I mean, they were, the loan applications had to be filled out by hand, in person. They didn't have, if they had fax machines, they were fairly new. People would fax their rate sheets over to people. When fraud was committed, it was committed by, doing a little bit of whiteout over a thing and then, typing in something over it. That was the technology at that point in time. You got to remember, when I really first started being heavily involved with California MBA, it was about 1994. That was just when personal computers were around, but the internet was brand new. The internet was brand new, and just not much before that, people were, the extent of computing power was, a Pong game at the Marie Callender's. I mean, that was basically it. The technology has radically changed everything, sped everything up, and permitted the kind of complications that we have, because it's, the computers keep track of everything and allow for a lot more accountability than what was present in those days.
Yeah.
So the biggest challenge is dealing with the technology and keeping up with all the changes that have occurred as a result of it.
Yeah, no kidding. Well, and one of the things that I know has always been a challenge is, especially in our state, is the notion of letting the dust settle after a new law or a new regulation passes doesn't seem to be the norm anymore. It seems to be we're not even going to wait for the dust to just throw the next one on top of that and the next one on top of that, and then eventually we'll figure out if it works or not. So to that point, what would you say at this point? What's the state of things when it comes to the environment and the legal side of the industry? And maybe what's to your point of view, the most interesting legal trend right now?
I think the most interesting legal trend is what you just described, which is the piling on of everybody's efforts to add regulations and make it, quote, make a difference. Believe it or not, there are still effects from the 2008 financial crisis, massive effects from that. That radically changed the landscape. And believe it or not, I'm still actually handling lawsuits arising out of loans originated in connection with that, going all the way back to 2006. That are repurchase cases that are still going on after this length of time.
Wow.
But what the biggest trend right now is, even though the problems have largely been worked through, and that sort of thing, I think politicians realized that there was a great political benefit from being a champion of consumer rights, and so they seem to climb over each other to try to be that champion. And the problem with that is not the desire to help consumers, because I think that's a worthwhile goal, and that's always a worthwhile goal, because we all benefit once that's done. The problem is that people who they go into it, their zeal exceeds their knowledge of the impact of what they're doing, and this is a very, very complicated industry, and it's become infinitely more complex in this last 10 years as a result of the Dodd-Frank Act at the federal level and the Homeowners Bill of Rights at the state level in California, and also the standing up of the CFPB, Consumer Financial Protection Bureau, or Bureau of Consumer Financial Protection, whichever regime you want to.
Depends on the year.
Whatever year that is. But as a result of that, the regulation and control of the industry has become, in my opinion, more complex even than, remember when they were flying the space shuttle, they kept track of every single tile in the space shuttle. Every single square inch of that vehicle and every component of it was kept track of. That's exactly what's happening in the mortgage industry today. Every step of the way, from the first initial contact to the last payoff of a loan, is governed by regulations and is supervised, and the people who are involved in the process are closely examined by a wide array of regulators. If you're doing business nationally, you've got the CFPB, you've got every single state regulator, and in those states there are different approaches to protecting consumers. To me, that's the most interesting trend, because it has created tremendous pressure on the participants in the industry to either comply with that or get out. And it has winnowed out a lot of thousands of potential participants in the industry, with, in my opinion, an anti-competitive effect, because you've either got to ante up with massive technology investment or forget about it. So
the barrier to entry is really high now. I agree.
Yeah, and it's going to continue to be that way, in my opinion. The technology is absolutely necessary. You cannot, in my opinion, be in compliance right now with all the rules and regulations you have to comply with without a massive technology investment. And I'd say that's the most interesting legal trend, because what's happening is a lot of the regulations and the compliance requirements with those regulations are being hardwired, if you will, into the systems. And And that's a blessing because you can expedite it. But I think I gave a couple of comments a couple of years ago at the Legal Issues Conference that I think were widely misinterpreted. There's a downside to it. And the downside is when you have it hardwired into the systems like that, and by that I mean it's put into the, it's baked into the software. When you have that done, people become more removed from the rationale behind the regulations and more removed from an understanding of why they're there. And that creates almost a slavish worship of the technology and belief that the technology is going to solve the problems and it's going to make everything right. Well, of course it is to a certain degree, but there are limits to it. And the output of the computer systems is directly related to the input, and unless you have the control of that, and it also requires some awareness of what's really going on. So the technology has largely replaced common sense, and I can't tell you how many times how many conversations I have with clients who tell me, well, the LOS has produced this result, or this compliance vendor that we're using says this, and but we don't know why, and we don't know, is this the right answer? Because we're being written up for it by one of the regulators. Like, well, you're in violation. You're in violation of the regulation. Well, how could that be? How could that be? We spent all this money on vendors to have this done. Well, it's just not as simple as your system seems to think it is. So
well,
that's,
I mean, it's only as good as the person inputting the information and setting the rules.
That's right. It's the old phrase, garbage in, garbage out. And unless you, and those rules are not, I mean, it's axiomatic to recognize those rules are not always as clear as the people who write them think they are. And then you have an overlay on it. Then you have the gloss of the courts who get involved, and they want to have their say. They all want to be champions of the consumer as well, at the appellate court levels particularly, where they think, well, we the great wisdom in our great wisdom as appellate justices, we think that we need to find and recognize duties that nobody ever saw before, that have always been there. They've always been there, but nobody else has ever seen them until now, when we're discovering them, we found them, and you now have to live by those rules. So,
are you suggesting that every judge is not a perfect objective arbiter of the law and may be influenced in part by their own personal biases and political leanings?
Yeah, it happens. I've heard that it happens.
Yeah, I would imagine. Well, speaking of specific legal cases, I know that as general counsel, one of your main responsibilities there is to sort of sift through the many requests we get for amicus to be an amicus on a case that one of our members is dealing with. And I know we've got a big one right now, Sheen versus Wells Fargo. Why don't you sort of explain, sort of the status of that, and where we're at with that?
Yeah, well, that case, I'm not going to bore everybody with the details of it, but the essence of that case is whether or not it's before the California Supreme Court, and the lower court basically held, let me sort of go back a little bit. For almost a decade now, there's been a fight among the courts of appeal over whether or not lenders and servicers owe a duty of due care, which is basically a negligence standard, a tort standard, a duty of due care to borrowers who are involved in the loss mitigation or loan modification process. And that arises out of a lot of the horror stories when people are trying to get loan modifications arising out of the 2008 financial crisis, where they would apply for a loan and then, it would be their application or for a modification, and their application would be transferred around with people, and they would keep asking them for things, and people would supply them, and the borrowers would supply them, but then another person would get assigned, and there wasn't a single point of contact, and their papers would get lost, and foreclosures would occur. So there was a lot of disasters as a result of that crisis, and those gave rise to a lot of the legislation and regulation that we have. They gave rise to Dodd-Frank. They gave rise to a lot of the modifications the Truth in Lending Act and the Real Estate Settlement Procedures Act that the CFPB made in creating the servicing rule in 2014, where they said, look, if you've got somebody that is in a loss mitigation situation and they apply for a loan modification, you have to respond to them within X number of days. You have to treat their application a certain way. You have to provide them with a certain point of contact. So there's been a lot of detail that has been supplied by the law in response to that. Well, meanwhile, during that time period, the courts began to decide these issues, at the judicial level. And there was a couple of decisions that, people would say, well, the lenders and servicers owe the borrower a duty of due care, which is kind of a radical concept because that's never been the case. Going all the way back to the
it sounds so, in a sense, consumer friendly. But to your point, I mean, sorry to interrupt, but I mean, it's one of those things where it, on the surface sounds benign, but
on the surface it sounds benign, and you'd think that was the case. But the problem is that duty, to the extent that well, first of all, there's a whole series of cases that go all the way back to even in the mid 80s. Back in the mid 80s, and a lot of people aren't aware of this, there's this whole movement to create a lender liability tort, to create a duty of due care. And there was a series, and this was at the commercial level, and there was a series of cases that came down, including cases by the California Supreme Court, in which they ultimately said, no, there's no duty of due care unless you have a special relationship with between the borrower and the lender. The lender's role, and this was codified in a case called Nymark, the lender's role is basically that of a debtor, the debtor-creditor relationship. And the lender does not owe a duty of due care as long as they stay within that normal debtor-creditor relationship. If they vary from that or they get involved with the borrower in some other way, such as some kind of a joint venture or something like that, well, then that creates a different situation. But for all these years, we've been living under that. But after the 2008 financial crisis, what happened was some of these courts decided to get a little bit more venturesome. They perhaps had forgotten about all the litigation back in the mid 80s, or weren't on the bench then, and they felt it necessary to begin to start addressing these issues. So a couple of courts said, yep, there's a duty of care, and we're going to impose that on the servicer, and we're going to allow the borrower to go to trial on that, and we're going to put that burden of care on the servicer. That all sounds great. Some other courts said, no, we don't think that's a great idea because this is an area governed by contract law. It's an area that should be governed by statute and regulation. And so it's a mistake to do that. And that's been going on for about a decade, all rising out of the 2008 financial crisis. The courts have been going back and forth, and there have been dozens and dozens of decisions, both back and forth. Some courts say there is a duty, other courts say there isn't a duty. Well, finally, so then this is entered the Sheen case. This is the case of Sheen versus Bank of America. And in the Sheen case, the borrower had a junior lien, wasn't his first lien on his property, wasn't his purchase money mortgage or anything like that. It was a voluntary, essentially second that he put on the property for various reasons. And through a series of events, he feels that he wasn't given his loan modification application was not taken into consideration carefully enough, and that the lender foreclosed without giving him adequate notice of that was going to happen, and has raised this issue that there is a duty of care. Well, the Court of Appeal, the Intermediate Court of Appeal, ruled that no, there is no such duty, and they went through a pretty detailed analysis of that. And he petitioned to the California Supreme Court, and they finally have agreed to take up this issue of whether or not there is a duty of due care that's owed by servicers and lenders in the loan modification loss mitigation context. And that has now been fully briefed. We had an opportunity to file an amicus brief on that for the California MBA, and we joined with the National MBA joined with us. And we also joined with a couple of other trade associations, California Mortgage Association, United Trustees Association. We filed a joint brief on behalf of Wells Fargo in that case, arguing that there should not be a duty of due care imposed, in part because of for a lot of reasons, not only historical legal precedent, but for a lot of public policy reasons, that that this is an area that has been heavily regulated, that trying to put it in the hands of juries and judges to try to navigate their way through the complex regulations that govern this process is likely to create inconsistent results and is likely to create more confusion and more difficulty. We have regulators who are heavily financed. The CFPB has hundreds of millions of dollars of financing, and they have extensive regulations, and they audit people to the nth degree in this servicing area. And if you make a mistake, you're going to be penalized. They're not going to miss it. They're going to catch it. And in fact, there's duties of self-reporting. And under the this AB 1864, which the governor has just signed into law, they've established the California Consumer Financial Protection Law, which adds even more responsibilities and beefs up significantly what was it used to be called the Department of Corporations. Then it became the Department of Business Oversight, and now it's the Department of Financial Protection and Innovation. And they have enhanced. You see it. You see a pattern here. They have vast powers, and they have powers now under this to. And I think they may have had them before, but now it's very clear. It's explicit. They have powers to enforce all of the regulations that the CFPB has power to enforce. A lot of people refer to them as the
response from the state to create sort of a mini CFPB out here.
I was just going to say that, yes, exactly, to create a mini CFPB. They were not satisfied that the CFPB was aggressive enough under the Trump administration, and so now in California, they've decided that they're going to make the California Department of Financial Protection and Innovation the new CFPB. Most mortgage lenders want to do business in California. It's a tremendous market, and it's something that's hard to resist. But if you come here, they are going to expect of you some very serious accountability for compliance with our consumer protection laws. And this state has it's a great temptation to the legislators to try to do something new for consumers. Every month, every week, every day, every hour. I think some of them lie awake at night thinking how they can do this. And if you talk to our legislative advocates, I mean, there are thousands of bills introduced every year, and there are dozens that have to do with the financial services industry.
Well, I remember just like even
regulation a good thing?
Prior to the financial crisis, I mean, our our advocates would deal with, maybe, a couple of bills a year that were really focused on the industry. And now it's, a dozen or maybe 20 bills a year that in some way, shape or form are going to have an impact on the industry.
Right. And they're not minor bills. They're major bills.
Yeah.
And so they're putting a gloss on everything. So I kind of got off the Sheen case, but that it just shows you everybody wants to participate in this process. Everybody wants to be the champion of the consumer, and that's fine. I get that, and I think it's in everyone's best interest that consumers' rights be very carefully protected and watched over. But because of all the layering and because of the complexity of the things, you have to be really careful before you just launch into it and sell some bill that sounds great and makes a lot of political hay, but can devastate and confuse everybody that's involved. And what happens is, and I know this for a fact, is that a lot of people who participate in the California market just price that in to their products in California. If you're gonna be a lender in California, you're gonna charge more for your loans if you can, in subtle ways, whether it's in the form of the interest rate or whatever. California borrowers going to pay for that.
Yeah, absolutely.
And it, as I say, it also discourages competition because in order to comply with all of that regulation, it's a very high standard. And so a lot of California businesses, a lot of California mortgage companies have been driven out of the business. They can't participate in California. They've moved out of California. They've gone to other states where the environment is more receptive to what they're doing. And some people say, well, good riddance. We don't need people like that. Well, yeah, maybe, but competition is always a good thing. And the less competition you have, the less California consumers benefit, the more they're harmed. So it's not a simple issue. It'll be interesting to see how the California Supreme Court comes out on this issue, because if they impose a duty of due care, that could dramatically impact the non-judicial foreclosure system in California. It could cause that basically California to become a de facto judicial foreclosure system, which would delay the ability of lenders to realize on their collateral in the event of a genuine default and somebody who really truly can't pay or won't pay. And that makes it, again, people will price that into their loans. If they can't realize on their collateral, lenders are not going to want to lend in California. There'll always be lenders in California, don't get me wrong. There'll always be people that lend here. But it gets complicated too for the private money lenders, people who, the moms and pops who invest in deeds of trust. If they have, they don't have the ability to comply with, they have the ability to comply, I suppose, but they don't have the technology or the technology investment to do these sort of things. So it narrows the pool of loans and credit that's available to borrowers. So that's kind of my soapbox, but those are some of the issues that we raised in our amicus brief, and we'll see how the California Supreme Court comes out on it. Either way, it's going to be a landmark decision.
Yeah, no, and I think you're right too about the, you mentioned the non-judicial system we have in California technically, but I think to your point, we've sort of been inching that way, towards a more judicial system, and it's not good for anybody. And so why don't you, we're sort of running a bit short on time here, so I want to get one piece of practical advice you would have for a lender servicer right now to sort of limit their liability, whether it's through litigation or regulation or even legislation. So what would be your one piece of practical advice?
Listen to your lawyer.
There's only one. There's only one.
Listen to your lawyer. That's it. That's it. Listen to your lawyer.
Well, that's practical in both ways there.
Yeah, it's a simple answer, but it's it's not just your lawyer. It's most companies have a team now of compliance professionals who and some of them don't include lawyers, but I mean they're essentially giving legal advice, they're giving compliance advice. Listen to the people who are trying to protect you, because they really are trying to protect you. The days of ignoring them, the days of thinking, oh well, I'll sweet talk the regulator because I know them, or because they would never come down against me. Those days are over with. Those days are over with. This is a highly regulated industry, and it is, and the regulations are deep and extensive, and the penalties for violating them are severe, and they can mean the end of your company. So if you're going to do business in California, follow the regulations. Just make sure you get on top of them. Make sure you understand them. Make sure you have people that are helping you, and that requires, as I said, the technological investment, but do that as well.
Yeah, no, I think that's simple but practical advice, to say the least. So as we close out here, go ahead.
One last thing I want to tell you as part of that, and this is a shameless promotion, support the California MBA. Really. I mean, I've been involved with the California MBA for, most of my career, actually. And I've seen it evolve into the organization that it is today. And it is very much involved in protecting the consumers of this state, as well as the people, the lenders and servicers, and the people who are supporting them. The California MBA is probably the key advocate in the industry for responsible lending and servicing, and they're also the industry that can help sort out some of the craziness and some of the insane ideas that come out and make them more rational, so that really the things that are, and this is at the advocacy level, people's support for that is vital. California MBA works closely with the national MBA. We have their resources at our disposal, and And I can just, I mean, I've known you, Dustin, and I know the kind of efforts that you make. We have committees that work on these issues. We have the Legal Issues Committee. We have the MQAC Committee. We have a number of other committees that help try to develop ideas and solutions to these problems. I don't think there's any organization that a mortgage banking company could join that would benefit them more than being members of the California MBA.
Well, thank you. Yeah, and for everyone out there that is interested in joining, October is membership month, so you can join right now and actually get a 15% discount off your first year dues. So if you're interested in membership, by all means, go to joincmba.com and you can get some more information about how you can join there. And Michael, again, hey, thank you for joining us today. It's been great to catch up and sort of get to talk some legal stuff. I mean, my background, one of my majors in college was political science, and I was always fascinated with the constitutional law topics more than almost anything else. The political philosophy was kind of boring to me, and to be honest, so it was more the practical, con law classes that were much more interesting to me. So I always enjoyed chatting with you about the state of things in the legal business here.
Feelings mutual, Dustin. Thank you very much.
Yeah, and hopefully we'll be able to see each other in person soon. So if you enjoyed the conversation, if you enjoyed this, the back and forth, and want to see another episode of Connect, make sure and click the subscribe button here on our YouTube channel. You can also catch us on Spotify, SoundCloud, or Apple Podcasts. And we'll be back again next Monday morning for another episode of Connect, and we'll see you then.